Today, this afternoon, I'd like to speak to you about the magic of leaps and long-term trading. I'm actually going to try to fit in a number of different strategies in the time that we have allotted. But as Dave said, I am Vince Fora. I'm the head trader here at Trading Wins, and I've been doing this for a little over 30 years. Over that time period, which has gone by extremely fast, believe it or not. I've developed several strategies and trading system. I'd like to share three of them with you here today. Three very simple but very consistent strategies. Please don't trade with real money until you are completely comfortable with whatever system you are trading. As you know, trading can be risky. Now, in today's presentation, I am going to briefly put up my money management rules. I really don't have a lot of time to go through them in detail. I'll just whip through a couple of slides very quickly. Then we'll talk about the winning momentum strategy, the monthly 10, and new all-time highs, trading new all-time highs. Now, we will focus today on the monthly time frame, on trading for the longer term. But having said that, 2 out of the 3 strategies here can be used on any time frame, including intraday time frames like the 3-minute, the 5-minute, 15-minute time frame. So all of these are based strictly on technical analysis. No magic here, just some patterns that work consistently. And I've traded these myself over many years and continue to do so today. And of course, along the way, I will try to answer as many of your questions as I can. Michael, thanks for being with us again. Michael's at many of our presentations. Appreciate you being here. Appreciate the support. So let's get started. Money management. I'm just briefly going to throw these on here very quickly and run through them because I do want to spend most of the time on the strategies. So these are 5 basic rules that I follow and have followed for a very long time. They've served me very well. The first one is not to be overlooked. After coaching hundreds, if not thousands of students over the years, what I found is mistakes happen most when you're either not feeling quite well, not very focused, just not in a very good state of mind. So try to always be in a positive focused state of mind before you trade. Trading really is not all about picking entries and exits. I'm going to give you those. You'll have plenty of strategies to use after not only my presentation, but the other speakers today. What you need to really focus on is how you manage that trade once you're in it. And so to do that effectively and not worry about the money that you have there, you should trade with an amount that feels completely insignificant to you, okay? Another way to eliminate risk when you're trading is to limit the amount you put in any one trade. We like to use 5%, but the real goal here is to eventually work your way to 1%. As your account grows, lower that percentage. That way you'll still have a decent sized dollar amount in every trade, but you know, even if that trade blows up on you, and you have only 1% of your account balance in there, it's really a very easy and effective way to trade and continue to grow your account. There are things that we can't control. News announcements that surprise us, events, God forbid, should another 9/11 happen, that sort of thing. That's the reason why we keep 50% of our account in cash at all times. That way, should something dramatic happen, and we end up taking more of a sizable loss, we always have money to put back into the account and make it back. And with the strategies I'm going to share with you today, really shouldn't take you that long. Now, last but certainly not least, you should spread your trades out. We've seen many days, even in the past couple of weeks, where the market has been up strongly one day, but completely reverses course the next day. That's where you get trapped. If you go in and you put 6, 7, 8 trades on during a strong day, and the very next day it pulls back against you, you usually end up finding yourself in a huge hole. So what you want to do is spread your trades out and select only 1 or 2 of the highest probability trades for whatever time frame you are trading. Okay. For those of you who are just starting out, learn to bank those profits, even if they're small at the beginning. Pad your account, grow your account, This will allow you to gain confidence in the system that you're trading, as well as in yourself as a trader. And certainly, always remember that trading is not about whether you're right or wrong. That's important. If you're in this to be the world's greatest stock picker, you're in it for the wrong reasons. Okay, but it is, however, all about how much money you make when you're right versus how much money you lose when you're wrong. In other words, it's about execution. It's about following those rules, building the right habits to remain disciplined and sticking to your trading plan. Okay, losses are a part of this business. It is a cost of doing business. They will happen. Your job as a trader is to control them. That's the main thing. And I'll show you how we do it with our strategies. So let's start talking about our 3 strategies. The very first one is our winning momentum strategy. Here we have a chart of Pfizer, FISV, on a monthly time frame. Again, this is a strategy that can be used on any time frame, any market, and whether it's Forex, futures, stocks, options, it doesn't matter. It's based solely on technical analysis, and we use 3 very common indicators. The first one is this blue line, the 20-period simple moving average, and we use that for momentum. What we're looking for is a slope on that 20. Okay, the more dramatic the slope, the better in the direction that we are trading. Okay, that gives us an indication of how much momentum there is behind the move. Secondly, this shaded area, the yellow and pinkish, what we call the cloud here. This is the Ichimoku Kinko Hyo indicator, otherwise known as the cloud indicator. And if I go into the settings here, I'll show you that we do use the default settings of 9 and 26. Those are the defaults on any charting platform. We do not change those. What we do is eliminate 3 out of the 5 parts of this indicator. So there are Tenkan, Kijun, and Chiku, which are 3 other, we'll call them moving averages. They're calculated slightly differently, but they're 3 other lines that you'll usually see along with this indicator. The span A and span B are the shaded areas that we have on the chart. What we want to do is hide those other 3. We don't need them. All we're doing is using the cloud to judge trend. So if you're using TOS, you just simply click on these tabs and make sure to uncheck the show plot button. Okay. If you're using a different trading platform, what you can do is go into each one of these and change the color to the same color as the background of your chart, and that will make them disappear. So what we want to always do, no matter what system we're trading with, is trade with trend and momentum on our side. Half the battle is already won before we even enter the trade if we do that. So the cloud, if price and the moving average are both clearly above the cloud, that is what we consider an uptrend. If both are clearly below the cloud, we call that a downtrend. And if one or both are overlapping, we call that an area of consolidation. And we do not want to use this strategy in that area. Okay. Now, the 20-period moving average, as I mentioned, we use to judge momentum. So whenever we bring up a chart, we're always looking at the far right. We look at the most recent candle. And there are 2 things that we want to identify immediately in a split second. And that is, do we have trend? And in what direction is that? Here you can clearly see it's obviously an uptrend. We're above the cloud. And is there momentum behind that move? Well, we look at the slope of the 20, and not only is there momentum, it's very good momentum, very, very strong here. Nice, solid slope on that line. So if we have both of those intact, thirdly, what we want to do is go down here and look at the RSI. This is the RSI, the Relative Strength Index indicator. Now, this is normally used to identify overbought and oversold conditions. We use it a little differently with a different setting. So the default setting on most charts is at 14. We cut that in half. We like a much more responsive RSI, so we use a setting of 7 on the RSI. Now, normally you'll see lines here, which we refer to as overbought and oversold lines at the 70 and 30 levels. What we do, or what I do, is change the overbought to 50, okay? And I eliminate the oversold line. Again, I unchecked the show plot button over here. You can make it the same color as the background of your chart. Regardless, what we want to end up with is a 7-period RSI with a line drawn right down the middle at the 50 level. And this is the indicator that is going to help us identify our entry point. So what we're looking for is, again, trend and momentum. So we want to identify a point where the stock is clearly in a trend and has momentum behind the move. Once we do that and we see that it's starting to retrace or pull back towards that 20. So if you look back down in here, when the stock had moved from below that cloud to above and then started to retrace, okay, we did have price and the moving average above the cloud, so we can say we had an uptrend, and we had slope on that 20. Okay, so we had momentum behind the move. Now, when we saw that retracement, we turn our attention to the RSI. And what we want to see is the RSI move from below back above that 50 line. The candle associated with that is what we would call our setup candle. So if you look at my crosshairs and I hover over the red candle, you can see at that time the RSI was below the 50 line. If I hover over the green candle, it is now above. So that makes the green candle our setup candle. And all we do at that point is mark the high of that candle. If this was a short trade we were looking at, we'd mark the low. But since it's a long trade, we're going to mark the high, and we're going to wait for a trade 1 tick or 1 penny above that high. If we get it, and at the time that we get that trade above, there's still slope on that 20, then we go long, and our stop goes just below the most recent low. So the one thing I want you to focus on is the risk. From entry to your stop, it's usually very small compared to the potential reward here. Okay, now none of us have a crystal ball. We don't know exactly where this run will end, but for the most part, your winners should be much greater than your losers. Now, the beautiful part of it is that you get to control the risk. You get to decide on each and every trade whether you're going to accept this level of risk or not. Some of them that have a low much further away, you can just skip. You can focus on the ones that have the most slope on the 20 and have the smallest amount of risk. That's what I would suggest, okay? The opposite is true for a short trade. In other words, you'd be looking for price and the moving average to be below the cloud. You'd be looking for the 20 period to be sloping lower, okay? And then you'd be looking for a pullback into that moving average and across from above to below the 50 line on the RSI. The exact opposite of what I've explained here, okay, for a short trade. And what you'll also notice is that it's very consistent, especially during a nice sharp trend. You can see here the nice run we had up. Once it pulls back again, here's that RSI going back to 50. As long as it touches the 50 line, that's good enough. It cannot end shy of it. Okay, it has to at least touch it, preferably dip slightly below and come back above. So this green candle here would have been our next entry point, our next setup candle. Break of that high, and you're still in that trade. For an exit strategy, you can use a close on the other side of the moving average. You can use a tighter moving average, an 8 EMA or a 10 EMA, and look for a close below that. Okay, and many different exit strategies, and we'll talk more about that in a little while. Since I have limited time, I want to get to the next strategy. If keeping an eye on 3 different indicators is a little complicated and you want to make it even more simple, here's one way to do it. It's what we call our monthly 10. Now, this one, I suggest you only use on the monthly strategy, okay? And the monthly, it doesn't mean you have to be in these positions for months or years. Some of them make a move right away. You can start scaling out. It also provides you flexibility. Having time on your hands, in your favor, I should say, is a good thing, especially if you're trading dividend-paying stocks. You'll be collecting dividends along the way. You could be selling call options against these to bring in additional premium. There are many different things you can do to add to your profit. on a trade, and I'll touch on more of those near the end of the presentation. Now here, what you're seeing is a chart of the SPYs on the monthly, the S&P 500, and the white line here is a 10-period simple moving average. What I have found over the years is that when you put a 10-period moving average on a monthly, price tends to spend the bulk of the time on one side or the other. In other words, you don't get many crosses. There are times like in here, okay, but you can eliminate those, easily by just focusing on the slope of that 20, the 10. So in other words, you want to take trades when price crosses from one side to the other at a time when there is slope already in place. So you can easily, depending on how aggressive you are, you can take every cross, okay? I'm very conservative. I absolutely hate risk. I'll do anything to eliminate risk. So I will actually not take these cross points here where the moving average is either sloping in the opposite direction or is completely flat. What I will do is wait for the slope in my direction, and then when the stock closes on the other side and then crosses back, that's when I will enter, okay? And you'll have many entry points along the way, but what you also notice is that the stock or whatever market you're trading tends to make some nice strong moves. All right, when you have a dramatic slope, remember the slope indicates momentum. So it's not uncommon to get some exaggerated moves here, and they're so easy from a psychological standpoint, right? To help you remain in a trade for the life of that order, it's so easy following this, because as long as that price bar remains above the 10, there's nothing to worry about. So throughout a period like this, it would be so easy to just sit in there and not worry about this trade. Okay, very, very simple. And you can look at many different stocks. It doesn't matter what the symbol is. ABDM, let's try even this one. Look, this doesn't have a lot of history, right? But when it's trending strongly, it tends to stay on that one side, right? And that's what you want. That's what you want. Pick up any stock you want. Let's look at NVIDIA, maybe. Anything. If you want me to look at a specific symbol, by all means type it in and I'll have a look at it for you. All right. Let me clear off these drawings. I was actually going to use NVIDIA for my next example here, so I'll redraw those lines for you. But as you can see, throughout the area of consolidation here, right, flat 10 SMA, you do not want to take any trades there. And then throughout the stretch, if it pulls back and crosses again, that's when you want to get in, okay? Now, let's go to something even easier here. Let's clean it up. Let's take that 10-period moving average off, okay? And let's go back to NVIDIA. We can use any stock really, but I'll try to fit in a few more for you here. Let me try that again. For whatever reason, went to the wrong symbol. There we go, NVDA. Let's go to that monthly. And what you need to focus on, probably the easiest thing in trading, okay? And thanks, I see a bunch of symbols put in. I'll try to get to those with the time we have left. One of the easiest ways to trade is to look for a stock making all-time highs, not 52-week highs, but all-time highs. The reason being is once it overcomes all previous price action, there's nothing standing in its way. There's no overhead resistance whatsoever. And usually a stock or a Forex pair, whatever it is, the only way it gets to all-time highs is because there's strength in that instrument to begin with. There's buyers behind that move that allow it to get to that point to begin with. there's something going on, and whatever it is, it's positive. And once it breaks that 50, that all-time high, there's nothing standing in its way. So if you look here on NVIDIA, back in 08, it made a high, right? And then if we had marked that high, it took several years to get back up there. Okay? But once it did, that's where this big move started, right? And it never really looked back. Now, along the way, there were other previous highs. There are other highs that you could have entered on. So it moves up, it pulls back. Once it puts in this pivot, that becomes that new all-time high. If it breaks it, you can enter again, right? There was another one here. And now, the recent high up here of 269.20, that's our all-time high. If price gets back there and breaks above it, you know, you're free to enter once again. And we can look at anything. So let's see, a few of you have entered symbols. Wally says HTHT. I have no idea what that stock is. Let's have a look here. There you go. So this goes back to what, 2011 down in here. Okay, it makes this high here. And this is a great example, actually. I'm glad you put this in. So this is a great example. So let me carry this across. Okay, so this was the previous all-time high up in here in October of 2011, and the high was $6.88, right? It gets back here and it breaks that high right here, okay, in December of 2013. But here's a key. What you want to do is the bar that breaks that high, right? If you want to be a little more conservative, like I am, what I like to do is I like to mark the high of that bar. And then if there's follow through, if there's a trade above it, that's when I get in. The next bar never did trade above that, okay? It continued to consolidate, okay? But then this bar here breached that level. So if we mark the high of this bar, right? There we go. Once we break it, that's where the run started, and off we go. It really doesn't get any easier than this. And what you'll find on a monthly time frame, when you're hitting new highs, it means you have several months of upside, potentially years of upside. So not only can you sit on that position and hold that stock longer term, and if it pays a dividend, collect a dividend, you can sell calls against it, but you could also, knowing that it just triggered the all-time high, you can revert back to the daily chart and start picking off shorter trades on there, okay? Let's look at a couple others quickly. Shop for Ida. And again, this one doesn't have a lot of history, but you see, once it went public here, it put in this high, right? If you had carried that high across and waited for a break to new highs, look at that. That's when that run started, never looked back, right? Very, very plain and simple. One more, Tesla. Who was asking for Tesla? Noel. So have a look back here. There we go. All-time high down in here. Once it broke it, it went on a run. This then, once it pulled back, became the next all-time high. Okay, broke it. And here went kind of sideways. But, you know, it's not all of them are going to work out. They're not going to be perfect. Okay, and by the way, your stop can be, you know, I like to follow it with a nice tight EMA. That's the easiest thing. And usually if it doesn't go my way, I'll be out very quickly. But again, here, back in here was another all-time high, right? Back in here. And when it broke that, it was off and running. And these aren't small moves, right? We're talking about from about 290, you know, going up to 390, $100 move. Again, you don't have to sit through the whole thing, but even catching a portion of that usually allows you to do quite well. So now, what I'm offering today, if you go to tradingwins.com/leap, I'm actually not offering something. I'd like to give you something. This is a course that we have sold for $197 before. I'm giving it to you for free. If you just go to tradingwins.com/leap and click Save My Spot, we'll send you an on-demand video training. We did this class about a week and a half ago or so. And what I talked about here was not only these 3 strategies again, and went into more detail with more examples, but we talked about which leaps you can use to trade these. Should it be in the money, out of the money, which series? All of that we cover, along with how to sell those covered calls against it and bring in more premium. We talked about the poor man's covered call. We talked about collar trades. This is another option strategy where if you have the capital for it, you own the stock, you own a put to protect it, but you're also short a call, and I'll show you how to leg into that, how to get in with each portion at a different time to maximize the amount of revenue you're bringing in. Also, I go over a few different repair strategies. So if you're in a trade that has gone against you, because it will, some will, okay, regardless of how low the risk is to begin with, I'm going to show you a couple of different ways that you can maybe repair that trade to lower the loss or even get out of it at break even. Okay, so we're going to talk about all of that during this class. And all you have to do is go to tradingwins.com/leap and click on Save My Spot, and you'll receive this as a gift. Okay, JJ, it's not leaps, no S, just leap. Singular. tradingwins.com/leap. And or if you're asking what leaps are long-term equity anticipation securities. It's a fancy name for option contracts that have over a year to expiration. Okay, so a call option or a put option, but they don't expire for at least another year, and you can buy them sometimes 2 or 3 years out. Okay, so that's the other thing that I love about options is that you can buy a call or a put for much less than you can the stock. And when you have a year, 2 years to expiration, time is on your side, and the profits you can see from it are pretty substantial.